Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our guest on the show, Shahina Mukadam, who is an independent market expert, Lancelot Cunha of ValueX Research. He's a little late, he'll come in, and Sangeet Lakkar of Newberry Capital join me on the show. Many thanks to all of my guests for joining me. On the show today, we discuss what's aiding the rally in the insurance space. Most of the public sector insurance companies have outperformed, and that is something that we will speak about. Bajaj Consumer has rallied more than 30% in the 2 days when we discuss whether the fortunes of the company can change after the promoters sell stake in the company. Apart from it, we also discuss whether the cement space warrants a buy post ACC's numbers, even though the EBITDA was good, whether the internals had any bit of confidence to our guest. And finally, the last one is Edelweiss, and the stock is corrected from levels of 260 right down to levels of 70. It's managed to recover a little bit, but what are the concerns that are plaguing the stock, and what's the view ahead on the stock? So that's something that we will be speaking about. But first, insurance as a sector, and especially the public sector companies have done well, be it New India Assurance, GICRE, or the SBI Life. All of them have rallied. SBI Life also had its number, extremely strong set of numbers, beat the street on all parameters. So what's the way ahead of for insurance companies? So we'll talk about that. Sangeet, I'll start with you. Insurance is in the news today. Also, yesterday there was this big block in ICICI Lombard also. So activity seems to be ripe in the insurance space. What's your view of someone investing in this space? Is it a sector that you would invest in, or is it something that you stay away from?
So yeah, it's a clear buy for me, and I have been positive on this space since quite some time. So clearly, after demonetization, one theme which is sustained is the financialization of savings theme, and that is irrespective of the slowdown in consumption that we have witnessed. Now, even if we see the whether SBI Life numbers or the prior quarters HDFC Life numbers or Max Financial or any insurance company you pick up, you would see the sustained growth in the AUM and the premium. Talking specific to public sector insurance companies, I think that's more because of either a disinvestment news which may come in or something like that. But I think I'm more positive on the private sector companies, especially on the life insurance front. And within that, I like Max Financial, I think, because of compelling valuations. The valuations are yet to catch up with the other three listed peers. And I think the companies which are having more protection-oriented businesses rather than savings business is set to grow from here. Okay,
what's your sense on SBI Life? It came out with numbers, it's rallying. Is that something that you would like? I know as a general rule you don't invest much in public sector companies. What's your view on SBI Life as a company?
So SBI Life, I don't think is that much of a public sector company as such. It's managed by the foreign partner, and but it has a very strong USP of the distribution which it enjoys. But I think the valuation now is does not warrant a favorable risk-reward ratio. So it trades at about, I think, 4 times embedded value. Whereas you have somebody like Max, which trades at close to 1.5 times embedded value. Also, a key differentiator between SBI versus the rest is SBI has a fair share of savings related and the ULIP portfolio, which I am little wary of. Whereas an HDFC Life and a Max has a higher share of protection businesses, which is more preferable for me.
What's the risk if someone wants to invest in Max Life? So obviously the valuations are fair at this point of time, but it has its own share of concerns also because it hasn't been able to grow the way the other private sector companies have grown.
So I think the numbers have grown. Yes, the concern remains twofold. One is no banking parent. So there's always an overhang of the bank assurance tie-ups not sustaining all throughout with Axis. And the second is their corporate structure itself, because the insurance company is in the subsidiary of the listed company. So there is a holding company discount attached to it. So I think these are the two concerns I would say.
Okay, Shahina, what's your sense on the insurance space? Anything that you've recommended to your clients recently?
I have been positive on the insurance space, especially given the fact that the markets are very volatile. And in these volatile times, I think insurance provides some level of stability, because the way the insurance companies raise money as well as deploy the funds, I think they maintain a level of conservatism which holds good in these times of volatile earnings. Having said that, I think the recent positive that we've seen in terms of the premium growth, we just saw those numbers for the first half that came out. I think they're reporting very strong numbers also in terms of premium growth. HDFC Life was like, I think 60% plus type of growth that is expected in the first half in terms of premium. SBI itself, SBI Life is about 40% growth. So I think the earnings momentum in terms of the premium momentum is very strong, and it's also reflected on the bottom line. In fact, HDFC Life is my top pick in the sector. I prefer the private sector any which ways for the longer term, because when you're investing in insurance in any format, either in the equity or in your personal portfolio in terms of your insurance, I think you are looking at the long term. So there I would prefer HDFC Life. I think it is likely to gain market share given its growth. It has got one of the highest in terms of earnings, EBITDA, that is around 30% plus. Also in terms of book, it's fast increasing. It's like almost, if you saw in the first half, it's almost 2 times it's increased over the last corresponding period. So I think all things are working in favor along with the government policy, which is promoting move into these type of insurance products. So I would recommend a buy, but a long-term buy, because I think this whole rally has to an extent taken away the stock upside that we're likely to see over the next 1-2 years. But as part of the portfolio, it could take a small part of your
Okay, so HDFC Life is your top pick.
Yeah.
Is there anything else that you like in this space on the life insurance side?
Well, actually, some of the public sector have done well, like we saw in the last 2 days, but the stock price have already sort of rallied. So I would stick to HDFC Life. Maybe SBI Life is also decent, but that would be second to
And anything in
HDFC.
the general insurance space that you like?
I would prefer with HDFC, which still has got some bit of the play left in terms of insurance. I would go with the parent.
Okay, that would. Any sense on general insurance companies? You said you preferred life, but do you have view on the general insurance space?
No view as such, because the earnings are pretty volatile. I mean, it depends on a lot of contingencies and force major events occurring during the year. Fortunately for us, we haven't seen a real force major events over last couple of years. But so I would remain away from that space as such.
Okay, that's the view that's coming in. Max Life Insurance as well as HDFC Life are the topic, but insurance as a space, especially the life insurance segment, is something that our guests like. The second stock we want to talk about is pretty much the stock of this week, Bajaj Consumer. So, so that counter did manage to fall significantly, and it has corrected significantly on issues of debt. Now, what happened a few days ago was this big block deal in which 22% of the equity changed hands, in which the promoters sold to reduce debt, and a lot of funds, be it the HDFC Mutual Fund, Aditya Birla Mutual Fund, ICICI Prudential Mutual Fund, all of them bought in stake. Now, the promoter stake falls to 38%, and in an interview today to us, the promoter is saying that over the period of time, again, he will look to get his stake back above 51%. So he did this because it was necessary to save the reputation of the company and the company itself. What should one do? The rally has already happened, it's moved almost 30%. But what should one do on this counter? Shahina, are the troubles over for Bajaj Consumer? What's your sense on this?
I don't think there was any major trouble for Bajaj Consumer per se. The problem was with the promoter group, and they are over leveraging, which they had to sort of meet by selling, I would say Bajaj Consumer stock. So I don't look at it positively. I see it actually at best neutral. Basically, a couple of reasons. One is the promoter has been bringing down stake from 60% now. I mean, almost 60. It's come down to almost 38%, right? Now, whether he increases stake or not at a later stage is another story altogether, and we have to look at how the company performs. I don't think any promoter looks at giving a very good performance and letting the stock price rally and then buying back stake, right? So in my mind, the stock price is capped at current levels. Secondly, I think with the promoter holding just 38% stake, let us assume it remains at this level. Consumer, I think the industry gets its multiple because of the potential that we see and the driver of the companies to increase its market share, branding, etc. With 38% market share, I don't see the promoter really putting his all-out effort, in my view. I mean, when we have so many options available, I wouldn't be buying Bajaj Consumer at current levels. I would at best be neutral.
At best be neutral. And what about the financials? You think it will struggle given the slowdown that we've seen, or will it be able to pass through that?
See, it has been growing in the single digit, both on top line as well as on your profits. So I think it will continue. Single digit, say 7 to 8 to 10% type of growth, both on top line as well as profits. We have seen over the last 2 years that has not really changed. So I expect that to continue. But in terms of valuation, if you see pure valuation, I think everything is fully priced into current price, because the EV, the market cap plus if you take EV, because it's almost debt free, it's around 4,000 crore plus, somewhat in that range, and the turnover is below 1,000 crores, or even if you take 1,000 crores, it's 4 times turnover. So even if I'm looking at pure valuation of the products and the brands, I think it's already there in the price at current levels. So if I was to look at the stock again, maybe with some M&A activity in future and whatever, you know, all the possibilities open up because of the low promoter holding, I would still not give it a valuation of more than 4,000 crores. Balance sheet, there is no problem. So there's no problem per se in the company. But in terms of valuation, I see upside being capped.
You're saying it was basically a promoter issue, not the company issue?
Not the company issue, no.
Sangeet, is that, will some of these large funds that come in, we've seen the rally that come in, but will this sustain?
So again, I have a neutral view on the stock. There could be a 5-10% uptick, but I mean, besides that, I don't see a investment case. If you see the product portfolio, they operate in a very, very niche segment of hair oil, and that too specific to almond oil. I have hardly seen any innovation in this company, any new products being launched, or trying to upscale its product profile. And if you see, this also shows in their last, if you evaluate this company on a 10-year basis, I think the growth has been at best single digits, including the last quarter which they reported. And there are hardly any capex which is going into the company. So most of the cash flows which is generated is distributed as dividends. That's why you have a very high dividend yield at 5.56%. So yes, if you see, if you compare it to the other consumer companies, optically it looks like, yeah, an ROE of 45%, a dividend yield of 6%, trading at 15 times, vis-a-vis probably a Nestle or trading at 70 times, 60 times. But I think this is trading cheap for a reason, and the reason is there is no sustainable growth. So I'm pretty neutral to the stock. There could be tinkering here and there in 5-10% because of the promoter pledge and institutions coming in. But unless I see a little dynamism in the business, introducing new products and etc., I wouldn't venture into this.
Okay, anything that you've told in the FMCG space that you've told your clients to accumulate? HUL's commentary was not all the best, though it came out with decent set of numbers. You feel that this time around FMCG there will be weakness? Bajaj Consumer came out with really poor set of numbers, but HUL also was a little muted. What's your sense on this space?
So pretty expensive. I mean, every investment case, I mean, I would look at the valuation as the first parameter. And none of the consumer companies in my mind, maybe barring something like a United Spirits, warrants an investment at this particular price.
Okay, anything in the FMCG space that you recently told your clients to accumulate?
I would go with the United Spirits recommendation that I had from a long time, and I think yes, it's building its market share and very good products, so strong balance sheet. So I think I would agree with that call. I would also add one on ITC. I think ITC has, really not participated in the overall FMCG rally that we saw in the last 2-3 years. And in terms of valuation, it is available at very attractive levels. So I think it could be one that you could add for the long-term portfolio. I would say that it is building its other businesses over and above the cigarettes. So I would be adding ITC, yeah, and we have been recommending both ITC as well as HUL has been a long-standing. So there are stocks. In fact, HUL I personally have in our portfolio, in my family portfolio. ITC also we do have. But I think these are stocks that one holds for the long term because valuations are extremely expensive. So it's not that if you get in today, you are expecting to see a 20-25% type of stock performance, immediately. But I think over a CRG period of about 5-10 years, you definitely see a 10-15 type of percent performance and good stable businesses.
Okay, that's the view that's coming in on the counter. Bajaj Consumer, that doesn't get the thumbs up, but counters like a United Spirits does indicate that there is an ITC, could be better picks at this point of time, not Bajaj Consumer. The next one is on ACC. Now ACC came out with numbers 2 days ago after market hours. Numbers were extremely strong. Yesterday was up almost 3% but cooled off by the end of the day. Now the EBITDA beat was clearly there, but volume again was disappointing, and some of the other factors were also slightly disappointing. But does ACC results give any indication of how the cement sector will fare out during the second quarter? Let's ask our guest. Sangeet, I'll start with you. Firstly, what did you make of ACC's number? And secondly, does that give any hope that probably the rest of the cement companies can surprise on the positive side?
So ACC numbers, as you correctly mentioned, the volume disappointed. I mean, you had a negative volume growth of 2%. Though operational performance was beat by quite a distance, the profit increased by 45%. I think it's too early. I think we had an extended period of monsoon, so I'm not too sure whether the Q2 numbers for all cement companies would be strong. Also, this was the first quarter immediately after the elections, so I'm not sure whether the government spending also would have kicked off in a big fashion. I think Q3 would be important to actually see if the demand is picking up. Also understand that the about 50-60% of the demand for cement comes from the real estate segment, and real estate segment has been the pain point of the economy for I think last couple of years, and until that kinds of turns around, along with the private sector capex, I think cement demand is some time away, I would say.
Okay, and overall your view on not only ACC, overall any of the cement stocks that you've recently told your clients to start accumulating?
Not really. Maybe Dalmia Bharat, just because valuation looks cheap, but not a screaming buy in that sector as of now.
Okay, you believe that there still will be pain, despite that valuations are not all that expensive, but despite that you believe that cement will face headwinds going ahead?
So one is, as I mentioned, the real estate demand. I don't know whether that is coming back in immediate times. And second is the government spending. I mean, because of I think government also is working on a very tight fiscal space now. So how much room does government have to spend, or to that is also to be seen. So I would wait for a couple of indications at least coming to spur up the demand.
What's your sense on cement? Do you like this sector, and what do you make of ACC?
Yeah, I actually like the sector. I have been recommending it for a couple of months, expecting that volumes will pick up. So I agree with Sangeet that the volume decline has been a bit of a disappointment, and it just shows that there is a major slowdown in the real estate sector and volumes are still to pick up. And I do hope that the government is able to give its push on infrastructure to see volumes pick up in the overall cement sector. Having said that, I think the ACC numbers were much better than what I had expected, as well as when I read other broking reports, I think it is better than other analyst expectations also, both in terms of the top line as well as in terms of the profits. I think they have managed their cost very well. So in terms of cost control, it has reflected positively on their EBITDA as well as on their profits. And as you see, even for the first half, now this is the third quarter. So if we see for the first 9 months, they have done pretty well in terms of it's been one of the highest EBITDA that they are showing on a per ton basis, which like over a long term period. and giving these numbers, it is I believe that they will be able to maintain it. We are hearing that the prices of cement in the south are likely to increase. ACC has a all India presence, so I think there could be realizations were higher in this quarter, third quarter, and I do hope that if they are able to maintain better realizations, they could possibly tide over these difficult times and volumes being depressed. So I remain positive and I continue to hope.
Any other cement stock that you like apart from ACC?
I prefer, no, I think I would just go with an ACC and a Gujarat Ambuja cement, because I would avoid Ultratech. I think Ultratech, the valuations are much more expensive, and they are finding it, in my view, a bit difficult to, actually absorb that huge capacity they took over in the last 3-4 years. And I would just prefer ACC, because ACC and Ambuja cements, I prefer this group.
Okay, that's the view that's coming in on the cement space. And the final stock is Edelweiss. Now it's trading at levels of 240, 250. Cracked all the way suddenly. It's been a marked underperformer, at least in this fiscal itself. So there are a bit of concerns. We'll try to find out what exactly has gone wrong and what should happen. What according to you went wrong with Edelweiss? It rallied significantly, but then the correction was also equally sharp on Edelweiss.
Yeah, I think it is facing the same challenges and problems that all the other NBFCs are facing, and in addition to that, I think the latest the costs. They are finding that the cost of borrowings is going up, the cost of doing business is going up, but at the same time you have the credit rating that is coming down. So it is just going to get more and more difficult for them to actually improve their margins, which we already saw that there was a problem in the last year. So I see that continuing to impact on their profitability, and I think the exposure that they have to the real estate segment is pretty huge. So to that extent, we don't know really what bad news is likely to continue to come. So I would just avoid Edelweiss along with most of the other NBFCs at the current juncture.
Okay, that's a view. Lancelot, thanks for coming. I think traffic kept you. We were just discussing Edelweiss. The stock has corrected massively. What according to you was the big issue? It rallied also, but then the correction was also equally sharp. What was the concern that people had on Edelweiss?
I think the lack of liquidity available in the market is definitely an issue as far as their growth is concerned. Second is the large exposure to the real estate book. I think they have close to 15,000 crores of real estate, as well as loan against shares, which was again a major major part of the book. Now both these segments, while they have de-risked it to an extent, are beginning to see some amount of stress. And on the other side, you have short-term repayments, which you will have to keep making, while the recoveries may not come in as far as as quickly as expected. So this definitely will put stress on the balance sheet, as well as force them to raise capital. They have in turn tied up to try and raise capital by selling off part of their private wealth book to a platform company, but it's still a long way off. If they're not able to raise capital, I think there could be a serious issue as far as the
you think they are out of trouble yet, or out of the woods yet? If someone wants to make a long-term investment, is this the right time, or should they wait for more clarity?
I think the key thing to watch out for is, one is the recoverability of the real estate book, and the second would be the ability to raise capital. If they're able to raise another 5,000-6,000 crores by way of capital by divesting part of their investments in the the wealth management business, maybe the asset management, the ARC, that 6,000 crores would give them significant cushion to take care of any kind of stoppages in terms of NPAs coming up.
Okay, Sangeet, what's your sense? What according to you went wrong for Edelweiss?
I think clearly the real estate exposure, I mean, and you have seen across the board, whether it is Piramal or Edelweiss, I mean, with quest for a higher growth, undisputedly there were underwriting compromises possibly, and coupled with that, you have seen an NBFC slowdown, you have seen couple of builders defaulting, etc., etc. But I think it's a binary event for Edelweiss. I think market right now is pricing the worst. The situation could hold true, the things could get worse from here, but if they are able to survive this patch and it's always a cycle, and if they're able to live through this cycle, then this could be actually a multi-bagger. Because see what the management has promised last year, that they wanted to clearly differentiate between the three of their businesses, credit, the advisory and the insurance, and they want to bring in a strategic partner in each of their businesses. If you see, even in such tough times, they have been able to do so, and they have been able to get the best of their strategic partners. The credit business now has CDPQ, the advisory business has Cora Investment, and they have a small insurance venture as well. And if you see the valuations at which these strategic partners have entered, and it's not pretty dated, or the strategic partners have entered since last couple of years itself. So the SOTP value for all the businesses taken together comes to 20,000 crores based on what the strategic partners have paid. The market cap right now is about 8,000 crores. So yes, there is a risk. It's only suitable for a very high risk kind of an investor. But there could be some money to be made, but yes, there is a risk involved.
Okay, that's the view that's coming in on the final stock, that is Edelweiss. Very quickly, we'll just take Lancelot's view on some of the stocks that we discussed. First, insurance space. Is there any stock that you like, on the life side or the non-life side?
Well, I think all the insurance companies, the three which are major insurance companies like SBI, HDFC, and ICICI Pru, they're all looking attractive, but the valuation is expensive at this point in time, and it's mainly because we've seen a large under ownership in the sector from the institutional players, as well as this is one sector that is promising growth, quarter on quarter and year on year for the next couple of years, and the market always gives a premium to wherever the growth seems to be, for the next 3-4 years is going to be fixed. So to that extent, it's better to wait for some kind of correction and then buy into these companies. But all the three life companies are good. I think the general insurance space, you have ICICI Lombard, which is one of the major company players there, and you can also buy these through the Bajaj Finserv thing. But the valuations are expensive. So
okay, we discussed two other stocks. We just have time for one. Either if you want to speak on Bajaj Consumer or the cement space, you can take your pick.
So I think cement space is something that is looking into a long-term bull run, but in the short run, you're seeing pricing pressure as well as you're seeing capacity utilization sort of having a negative impact. Because in the short run, whatever impact we are seeing as far as the real estate side is concerned, as far as infrastructure is concerned, the offtake is not that high to increase capacity utilizations. If you look at price increases also over the last couple of years, the price increases have been minuscule. Now, if there's more pressure on the companies to sort of sell more in terms of volumes, there will be a forcible reduction of price, and the price discipline that was maintained so far may not sustain in the near term. So one should look at, from a valuation perspective, a lot of these companies have run up on the back of good news, etc. You might see an in higher price rise, but that should be a time to actually reduce exposure and wait for a correction. Long term, yes, we are in a bull run as far as cement is concerned, and as the GDP grows,
which is the best pick in the cement if someone had to play the cement scene?
I think at this point in time, Shree Cement would be one of the companies one can look at. Ultratech is expensive, so you have to wait for it. Maybe Shree Cement at this point of time looks attractively priced.
Okay, that's the view that's coming in on the cement space as well as the insurance space that Lancelot has said. But we are completely timed out on this edition of Hot Money. Let me thank my guests who have come in today. Lancelot, Shahina, Sangeet, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to BloombergQuint.